Hi everyone and welcome to this YouTube channel. In this video, we are going to talk about stocks as crypto. So before starting this video, please like this video and subscribe to our channel for future updates. Stocks. A stock is a fractional ownership interest in a business. It's easy to lose sight of this if you become overwhelmed by the wiggling stock prices and the potential for profit. As a legal ownership stake in the business, the stock gives shareholders a claim on the assets and cash flow of the business. These back your investment and provide a basis for its valuation. Why stocks rise and fall? The stock price moves as investors assess the future success of the company. While investors may become overly optimistic about the stock in the short term, the stock price ultimately depends on the company's ability to grow its profits over the long term. That is, a stock rises in the long term due to the success of the underlying company. For a stock to be a successful investment, the underlying company must perform well over time. Cryptocurrency. Generally, cryptocurrency is backed by no hard assets, specialized stablecoins being an exception, and that's the case for the most popular crypto coins such as Bitcoin and Ethereum. A cryptocurrency may allow you to perform certain functions, such as sending money to another person or using smart contracts that automatically execute after specific conditions are met. Why cryptocurrency rises and falls? Because cryptocurrency is not backed by assets or cash flow. The only thing moving crypto prices is speculation driven by sentiment. As sentiment changes, prices shift, sometimes drastically. So cryptocurrency is driven only by the hope that someone will buy it for more in the future. What's called the greater fool theory of investing. For a cryptocurrency to be a successful investment, you must get someone to buy it from you for more than you paid for it. That is, the market must be more optimistic about it than you are. Check out this beginner's guide to investing in cryptocurrency. Pros and cons of investing in cryptocurrency versus stocks. Pros of investing in cryptocurrency: possible hedge against fiat currency. For some investors, one of the biggest appeals of cryptocurrencies is its decentralized nature. It's not controlled by central banks or governments who like to print money and generate inflation in fiat currencies, such as the US dollar or the euro. Cryptocurrency has been called digital gold by some investors who hold it because they think it will protect them from inflation. Potential for outsized gains. Buying cryptocurrencies creates the potential for large gains on your investment. Several cryptocurrencies have seen their prices skyrocket since first being introduced. These gains are the main reason people are attracted to cryptocurrencies, but the potential for price appreciation comes with significant risk. Growing number of coins. In the early days of cryptocurrencies, there were just a few coins that could be invested in, but the speculative interest has changed that. New coins are introduced regularly, and there are now thousands to choose from. Wide interest in digital currencies. There seems to be a growing interest in cryptocurrencies from investors, companies, and governments. Tesla holds Bitcoin on its balance sheet and briefly accepted the digital currency as payment before reversing course. El Salvador adopted Bitcoin as legal tender in 2021, though the International Monetary Fund has urged the country to reverse its decision. Increasing acceptance of digital currencies could be positive for investors. Cons of investing in cryptocurrency. Extreme volatility. Cryptocurrencies have been extremely volatile so far in their relatively young existence. They aren't backed by anything, so the price they trade at is determined by the whims of traders. Fortunes can be made and lost quickly, and there's no telling where a coin might trade next. Cybersecurity risks. Despite cryptocurrency enthusiasts touting the security benefits of digital coins, there have been notable hacks involving cryptocurrencies. It is often difficult to recover stolen funds. No intrinsic value. Cryptocurrencies have no intrinsic value, which means they aren't backed by underlying assets or earnings the way that stocks are. Stocks have value because of their future earnings power and what they will return for their owners, while cryptocurrencies offer nothing of the sort. Regulatory risks. While El Salvador has embraced Bitcoin, many governments are much more skeptical about cryptocurrencies. China has banned them altogether and other countries could follow suit. Pros of investing in stocks. Long history of solid returns. Stocks have a long track record of producing solid investment returns, with the S&P 500 returning about 10% over the long term. Though stocks can be volatile in the short term, they have generally been safe to hold over long periods of time. Have intrinsic value. A stock represents an ownership interest in a company, and its value over time depends on the success of the underlying company. Companies own assets that produce earnings and cash flow for investors, creating what's known as intrinsic value. Accessible. It is easier than ever to invest in stocks these days, with many online brokers cutting trading fees to zero. You can invest in individual stocks or choose to purchase a diversified basket of stocks through an index fund. Index funds help keep costs low, and you can build a diversified portfolio even if you don't have much money to start with. Stronger regulation. Stock exchanges, brokers, and companies are all heavily regulated through various government agencies. Companies are required to provide certain information to investors through the Securities and Exchange Commission. No regulatory body is perfect, but stocks have been around for a long time, and there are certain investor protections in place. Cons of investing in stocks. Volatile. When you hold a broad basket of stocks through index funds, stocks are less volatile than cryptocurrencies. Individual stocks can be more volatile, but typically less so than cryptocurrencies. Because of this volatility, stocks are best held as part of a long-term investment plan so you have time to recover from any short-term losses. Lower potential for extreme gains. Broad stock indexes like the S&P 500 likely have less potential for the extreme gains that can sometimes be found among cryptocurrencies. Stocks have returned about 10% over the long term, whereas it's not uncommon for cryptocurrencies to move 10% in a single day. Other considerations when investing in stocks versus crypto. Time horizon. Your time horizon, when you need the money from an investment, is a key criterion. The shorter your timeline, the safer your asset should be so that it's there when you need it. The more volatile an asset, the less suited it is for those with a short timeline. Generally, experts suggest investors in risky assets such as stocks need at least 3 years to ride out volatility. Stocks. Stocks are often volatile, but they tend to be less volatile than crypto. Individual stocks are more volatile than a portfolio of stocks, which tends to benefit from diversification. Stocks are better suited to investors who can leave their money alone and don't need to access it. Generally, the longer you can leave it invested, the better. Some stocks can be more volatile than others. For example, growth stocks tend to fluctuate much more than value stocks or dividend stocks. Investors may shift from more aggressive stocks, growth stocks, to safer ones, dividend stocks, as they need to tap their money, such as when they approach retirement. Cryptocurrency. While stocks are volatile, cryptocurrency is ridiculously volatile. For example, during 2021, Bitcoin lost more than half its value in a few months and later gained 100%. Such volatility makes crypto unsuited for short-term investors. Crypto is better suited to traders who can leave their money tied up and wait for it to recover. Think years rather than weeks. Thanks for watching.